So just yesterday, we had a bunch of upward stock price revisions from Wall Street analysts. Obviously, the Q3 call was really good news. And what I want to try to do in this video is take a look at what we're thinking about as long-term bulls. Obviously, we know that we're excited about Optimus, we're excited about FSD and the robotaxi future. But I think what really starts moving the stock price is when Wall Street gets excited about near-term earnings. So what I think we saw with the Q3 earnings that dropped was that Wall Street is now essentially having to re-underwrite their near-term earnings expectations. And I think in the history of Tesla, what has really moved the stock more in a short period of time is when near-term earnings estimates get revised upwards rather than, Elon introduces some new product that 5 years from now is going to be truly revolutionary. So while we're still very optimistic about the real long-term extreme cash flow generating activities that Tesla's going to have with Optimus and the robotaxi network, what I think the market is really excited about is the fact that near-term earnings are going to go up. So what I'm going to try to do today is put on my MBA hat. I actually am an MBA. Don't let word get out, but I went to U of M and got my MBA there. But talk about what's changed in 2025 in my own kind of earnings model based on what we just learned in this Q3 report, so we can get an idea of where Wall Street was thinking next year would show up versus where we now think Tesla's probably going to show up, just to show how significant the near-term earnings movement might be and what that implies about price targets. So without any further delay, let's get right into it. I've got my model here, and just to kind of orient everyone, this is the same model I've been using for years now to look through Tesla's earnings potential. It's proven to be very accurate. I've had to make some modifications over the years, but essentially we just have all of our different income statement line items going in column A. There's a bit of a buildup, and then Q3, we've got the actual results here in column Y, and we've got Q4 in column Z, and then the next several columns are just 2025. So I'm taking a very near-term snapshot. And again, this is just to see how Wall Street is thinking about it, not necessarily what we're most excited about. And what I've done here is adjusted the model to reflect what Wall Street was expecting going into the Q3 earnings. So I actually looked in the Wayback Machine on Yahoo Finance and saw that Wall Street was expecting an average of 65 cents in EPS in Q4 and then $3.10 for next year. What this model essentially does is walk through how that buildup might look. So let's just take a quick look through some of these assumptions and then how they've changed. I think that the first and most significant assumption is that Elon mentioned that FSD take rate went up significantly, especially after the 10/10 event. So there was certainly some amount of expectation that I think FSD take rate was assume it's flat until we're proven otherwise, because it's been flat or even shrinking for many years now. But what Elon said is that, first of all, we had a lot of FSD revenue recognition way beyond what analysts were expecting in Q3. And then we know that in Q4 and beyond, it's going to be higher based on this take rate. So I have modeled out here a little bit of an increase in FSD take rate on upfront purchases, and that's really just to reflect the fact that it's going to be launching in new geographies next year and getting better. I think what we have to do is say, okay, given what we learned, take rate has to go even higher. So I'm only adjusting here the take rate on or subscriptions, but with this little change, you can see going from around 6% of the fleet today is my baseline assumption. If you have that increasing to around 11%, then you're getting EPS going from 310 to 317 next year. So one thing just to reorient everyone, watch this number in particular as I'm adjusting some of these variables to see how changes in assumptions based on what we learned might increase the earnings per share next year. So this is something that I think like Wall Street's really going to be forced to start modeling out separately. I don't know how many firms are actually modeling out FSD subscriptions or overall take rate, but I think it's getting to the point where you really can't ignore it. And especially if it's going from roughly zero or just like a couple $100 million per quarter today to potentially something a lot larger in the future, given the increase in geographic expansion and the increase in functionality, this is going to be very important to keep an eye on. So that's one change. A huge change, I think, is on the energy side of the business. I've modeled here just a modest increase in stationary storage deployments. The big piece of news we got in the letter, in the shareholder deck, was that they're essentially modeling for 9+ gigawatt hours of deployments in Q4. And so given the fact that we were already there in Q2, the fact that you've got Shanghai kind of ramping up, I think a lot of analysts are going to be looking at a forecast for energy storage that might have looked something like this for next year and saying, okay, we really need to ramp that up. And especially when you consider that the Shanghai plant is coming online like very quickly, if you only have Lathrop at full capacity and Shanghai at full capacity, you're at 20 gigawatt hours per quarter. This estimate getting to 17 gigawatt hours per quarter, and that's including Powerwall also, might itself prove to be a little bit on the low side, but just to reflect the fact that there's a slow ramp up of when production actually happens to when they actually count as deployed. I've got that baked in here. So you can see just with these two changes we've made, we've gone from 310 in earnings per share to 329. And then another big change is just on the manufacturing margin. So everybody, I think across the board, even the most bullish of bulls, was surprised at how profitable Tesla was. And so even if we just assume that what I'm calling here the core manufacturing margin, which is just the gross margin on automotive, less regulatory credits and full self-driving, I think most people don't model it out this way, but I find it pretty helpful. If you basically just assume that that remains constant with what they achieved in Q3, and here, let me move this over a little bit just so we can show. If you do that, then you're getting another increase in the 2025 EPS. And then very significantly, energy gross margins were a total surprise. So I think almost everybody was expecting 23, 24, maybe 25%. They completely blew that out of the water with 30.5% gross margins. I think Wall Street's going to be a bit skeptical that that level is sustainable, but I think at a minimum, it's reasonable to assume that you work down from there as that kind of realized ASPs come back down over time. So maybe we assume that you start in Q4 at least 30% margins again, but then work that down back closer towards that 25% level by the end of 2025. So that's what I've done here. So you can see, I'm not going to go into the rest of the changes. There probably are some other changes you could make, like around overhead costs being lower than I think Wall Street was expecting. But with just these couple of changes, you can see we're going from 310 in earnings per share to 344, just with a few quick changes. And so that's a 10% increase in next year's EPS estimates. And it doesn't give any credit for higher volume of vehicles. It doesn't give any credit for like the robo-taxi network or like a network of even supervised rides where Tesla's got some ride sharing revenues coming in. But I think what you can see is you go from this situation where estimates for 2024 earnings per share were like in the 250, 260 range. All of a sudden, you're getting to more than 50% earnings growth on that. And so this whole story of Tesla the last several years, when I've got my MBA hat on, is, earnings have been declining. Volumes have been growing only marginally or essentially flat in 2024. So the growth story is kind of busted. Well, now even the MBAs will say, all right, growth is back on track. Maybe we're not doing 50% in volume deliveries, but what we are doing now, which is super important, is we've got very high margin revenue streams that are growing at an extremely high rate. And let me show you quickly what I mean by that. So again, let's look at full self-driving. I've got my total full self-driving revenue here, which is the recognition of deferred revenue plus the subscriptions. And actually, I've got my subscriptions on here, so maybe we need to add these together. But plus my subscriptions, plus the FSD on new sales. And so you're going from this level historically where it's been a couple $100 million. They actually disclosed in Q3 that it was $386 million of FSD revenue that was recognized. If subscriptions are growing at a significant rate and you've got higher volumes as well, all of a sudden you can be in a scenario where you've got almost $1 billion per quarter of FSD revenue. And so just think about that for a second. Over the course of 4 quarters, that's going to be like nearly $4 billion of revenue. And that's like pure margin revenue that is growing at a very significant rate. So what kind of PE multiple are you going to put on that? I mean, maybe you tax affect that and it gets to $1 in earnings per share. Like that's $1 in earnings per share of something that's growing at 300% per year. And by the way, has the potential to help you launch a robo-taxi network to the extent you believe in that part of the upside story. So you've got just like very high margin revenue that's growing very quickly. And that's what you want to apply a high kind of PE multiple to if you're an MBA type. And then you've got the exact same thing going on the energy side of the business. So you've got energy gross profits right now, $725 million per quarter. And by the end of 2024, even with these assumptions where you're, how many gigawatt hours are we at? 17 gigawatt hours. And you've got 1.3 billion per quarter. So you look at the run rate of that and we know that the TAM on that is way bigger than they're currently monetizing right now. And then you start thinking about, okay, well, what if rather than doing 17 gigawatt hours per quarter, do we believe in the actual terawatt hour scale, which would be something like 250 gigawatt hours per quarter. And so then you say, okay, we could be looking at 10 times this gross profit figure in the future, potentially. So what kind of PE multiple do we want to put on this? And again, the energy piece of the business, if you're at over $1 billion per quarter of gross profit, very little overhead expense is going to get attached to that, just like FSD. So you've got two pieces of the business, energy and FSD, which are doing over $1 per share each as a kind of run rate by the end of Q4 next year, and growing at an extremely high rate. So what kind of PE multiple do you want to put on just those two pieces of the business? I think you're in this scenario where your EPS targets for next year alone increased by 10%. But then the highest margin, highest growth pieces of the business are the ones that improve the most. So that's why I think we saw the stock price reaction up 22% the day after earnings that we saw. It wasn't really on the basis that people all of a sudden believed in robotaxis and Optimus. It was this near-term expectations that we have. We needed to re-underwrite, and all of a sudden it's looking a lot rosier than we were expecting. So I think that's where Wall Street is. I think that's why the stock had the huge rally that it has. And as much as I'm a believer in the long-term future as being the reason that we're invested in the stock, at the same time, I think you've got to look at how is Wall Street looking at these sorts of things. And this is the stuff that I think they're doing and saying, oh, wow, the actual core profitability or FSD subscriptions, these things are really taking off. And I think that's why we saw such a change in sentiment essentially overnight in the stock. A lot of Wall Street firms increase their price targets, and I think it was on the back of changing a couple cells in their models, just like I did here. So I'll end it there, but just wanted to share my thoughts on how an MBA might be looking at this. Let us know what you think in the comments. Feel free to reach out to us at rebellionaire.com if you want to learn a little bit more about what we're doing. I'm Matt Smith, and thanks for watching. Bye for now.